afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rennick. It is 2 p.m. here in Chicago with an hour into the bell. Mr. Jerome Powell, of course, head of the chair of the Fed for now, talking to reporters after doing nothing expected. A little bit of action in markets. S&P 500 peeking its head above 7,000 is a nice little trend there. Resilience in the equity market continues. The real action is in the chip makers. The SMH is your guidepost, your template, your binary yes or no quick answer for any given day on whether or not you should be long U.S. equities. And when this chart is going up, the short answer in my book is yes. Don't need to make it more complicated. It's where the growth is, it's where the disruption is, and it's where the momentum is. The chart is a beautiful thing. Higher highs, higher lows. What is not to love? Brief moments of consolidation and then extension higher. NVIDIA as well, after toying with lows below 180, breaking potential support, bouncing back in the last 5 days. Chart there looks pretty solid as well as we get some strength across the big giants for the first time in a little bit. Look at MAGS, M-A-G-S, Round Hill Fund, of course, with the top 7 in there. A nice bounce over the last 6 days. So this was also at the low end of its range, and it's perking up too. So you don't need to make it more complicated really than looking at semiconductors, and that group might be enough to push the NASDAQ above the old highs from October. Keep in mind, even though the S&P 500 has been trading at records now with the 7 handle, the NASDAQ did not get above those highs from the fall. So MAG's looking good, NVIDIA looking good, and the NASDAQ getting very close to a fresh breakout to the all-time highs. That's why yesterday I put the green light back on for stocks for my risk radar. This is what it looked like prior. Yellow while we were churning around in kind of that range below 7K. A little bit of spasms, as Brent Kochuba put it to us, in the volatility landscape. But the green light is now on stocks because the SMH is making highs, and that's your simple go-to. Don't make it more confusing than it needs to be. Chips up, stocks up too. Now, here's where things get a little bit messy. The macro is getting a bit messy here because obviously Powell's in a tough spot. He doesn't want to do anything because the market doesn't really tell him to do anything. The economy is not telling him that he needs to really do something either. Inflation's been pretty subdued. We've got 2 key prints coming out the next 2 days for inflation. It'll be important to watch what bonds and the dollar do there. But the red light is on the dollar as of yesterday because of the breakdown on the chart in a very real way. And you shouldn't take this lightly coming from me, frankly, because I've had a pretty good track record the last 5 years of following the dollar, and it has generally been one of stability, if not strength. Over the last, call it 8 to 9 months, it was about stability, but keep in mind that after COVID, it was actually about surprising strength. Remember when you had all the coiners and gold bugs talking about hyperinflation after we cut rates? Well, the dollar actually had this epic big rally that brought it back to dot-com levels, very similar with other periods of economic growth in the U.S. Then it chopped and went range bound for a while. And then we had this miniature range here between 100 in the dollar futures and 95. Yesterday and today we're fighting for that on the weekly chart now. Dollar's bouncing a bit today, which we talked about yesterday as being kind of a high probability trade to find some support. But now I think you have to have respect for the chart, the breakage for the dollar to the downside. If you're going to plant somebody in the role of Fed chair to have them do something for political reasons and not economic ones, and you start cutting rates for political reasons and not economic ones, then I think you actually do have some risk to the dollar. And I hate to say that because for the longest time I've thought that risk was very overplayed, but I do think it's part of the reason why the gold move is ramping up, and I think there is some truth to that. So we're red on bonds, we're red on the dollar, we're green on gold, green on stocks, and yellow on the coins. I think that is a perfectly fine place to be in general. So let's get some details on the flows and what's happening in the options market at a closer depth. Mr. Brent Kochuba joining us on the SpotGamma feed. What's up, Brent?
Not a lot. It's quiet a little bit right now, Oliver. I was commenting in our morning note that the straddle price, the 0DT straddle price for today's FOMC was only $30. There's about 40 bips, which to me was shockingly low. But as we look at the market right now, the S&P is exactly flat, and so Powell has failed to kind of spark anything, even in his comments. And to your point here, we have a lot of trades which seem like they are all tied together. Assets at highs, bond vol at lows, equities at highs, and so we're kind of waiting for something to break or make a move up or down, to your point. And I see a lot of risk in the equities. I think I use the analogy of kind of dancing on the rim of a volcano right now, where you want to keep partying while the markets are going up and while equities are going up and those semi stocks are still the thing to watch. But man, there is some spasmy type risk that is lurking just beneath that surface, and it makes it a little bit of a tough dance here, I think.
Yeah, tell us more about the spasms potential that we talked about yesterday, just from volatility getting fairly one-sided. You were talking about correlations again, implied correlations dropping below that key 8 level, where you can have some just kind of necessary volatility adjustment to get single stock volatility back in line with the index level volatility.
Yeah, just to reiterate what this chart is showing us, is it's showing us, it's looking at 1 month options for the top single stocks in the S&P 500 versus SPX index vol. And the spread between those two is getting very, very wide. What that tells us is essentially that people are very bulled up in the single stock space. If you look at the skews into the big earnings plays, everyone's leaning long. Microsoft, Meta, Apple, you look at those memory names, we've been talking about a lot of those. Calls are bid in that space. Equity vol on the opposite side of the equation is getting really squashed. And so what this creates is a situation where people are over their skis. And that feels great and is validated while equities continue to go up. That's clearly what's happening at the moment now. And so it makes my job tough here as an analyst to say, hey kids, settle down a little. There's these risks lurking. And what happens is when this unwinds, all of a sudden we have a risk-off event. Typically, it's a macro-type event. It was the Greenland situation. For a minute, we had a spasm. But to the point of the dollar, and I'm inflaming people on Twitter here mentioning the dollar because, look, I'm not a macro guy. I don't know. But the dollar cratering, and you see gold and silver just going bananas, and equities kind of going bananas. If that just unwinds, that's enough to force this correlation unwind, because what happens? Well, if all of a sudden bonds have a trade or we want to go to cash for some reason, then what do? You sell all of your equities. It doesn't matter whether you like Tesla better than the S&P. You simply sell equities and go into bonds, for example. So
Sure.
That's the risk here, that we have this jump in correlation that usually coincides with the vol spike, right? VIX generally will spike to something like 20 in that type of a situation. So that is the risk here at the moment. But again, right now the equity flows are moderately bullish, I would say, post Powell, and so equity unchanged is validating the fact that straddle was only at 40 bips today and was even lower yesterday with no news going on. So there's a lot of complacency, extreme complacency in the equity market, and that's great until it's not great anymore, and you just don't know what that catalyst will be.
Fair point. And that's why I've got your volatility dashboard with the term structure up here again today, just because, to your point, nothing really happening with Powell, so we're kind of coming down off that potential event. But the economic numbers, given what's going on with the dollar, given the pressure on the future Fed chair, and the fact that yields finally broke upwards through 4.2%, PPI, PCE, these two next things, I do think they're reflected in the term structure here correctly.
100%. And actually, if you look at the day-over-day change, we see that there's about a 2 vol point increase for the next 2 days tied to these events. Now, they're short-dated implied vols, 1 to 2 DTE, right? So there's a little bit of noise in there. But what that is telling me is that Powell certainly didn't assuage concerns about these 2 big data points coming up today and tomorrow. So maybe a hot print there causes some issues, right? That's just something to watch. I just think what's critical to note here is that you want to try to catch that bullish upside, right? Because everything does look like it's going to break out, but you have to appreciate that risk that's lurking. And because the index vol is so cheap, QQQ and Spider vol in particular is so cheap, you can buy call spreads for very reasonable prices here, but you can also buy 2-month out put spreads for reasonable prices as well. So you can express both ideas now in the options space because options are cheap on the index side. Not really true on the equity side. Single stock vols are getting pretty rich, but the fact that those implied vols are actually up a little bit after FOMC tells me that these data points maybe matter a little bit more, and that could be tied to some of the things that Powell said this afternoon.
Okay. So, there's definitely, even though the markets are a little bit kind of quiet in terms of net move, these volatility dynamics, I think, give us some tradable, avenues to kind of either hedge if we're, long. I continue to think that, there's a couple of real simple approaches in the market. Your core long SMH, basically, and you take advantage of maybe these low vol moments to hedge yourself. Pretty simple stuff, but I feel like it makes sense right now.
I don't disagree with that at all, Oliver. And I see at most 30 days out in time, generally like 1 to 2 weeks here, and as more volume flows to the front end of the kind of tenor space, so to speak, zero DTEs, et cetera, that shrinks how far out I think a lot of this data is kind of actionable. And so to your point, we could very well glow up 10, 20, 30, 40% this year. But in the short term, you see that things are just very overbought. Now, we're going to go to earnings tonight. We got the mags all reporting. All of those names are roughly reporting or estimating about 5% implied move for their earnings. But people are leaning into calls into those events. I think largely the Mag 7s are going to be kind of non-events. I don't see a signal of a big 10 to 20% move in one of these Mag names. The stuff to me that's more interesting is LRCX is reporting. I've been talking a lot about that one. That stock's up 35% this year. And then we have SanDisk reporting tomorrow. That stock's up 100% this year. There's huge implied vols related to those names. And so if you think about what the most bullish vector is that has been this year, it's been these memory chip names, right? We were talking about Microsoft buying a lot of the inventory from a Korean chip manufacturer yesterday. So this is sort of the front bound, right? The leading horse, so to speak, in this semiconductor trade. And expectations cannot be higher for these names based on implied vols, right? If the IV rank is 100 into earnings, it means that you have to have incredible earnings to sort of justify these moves. So you can have good earnings out of these names, and then there's just pullback, right, where they just need to cool off because the options are so expensive.
They are, by the way. I'm looking at LRCX, 125%, for the Jan 30th.
It's really wild implied vols in that space. And again, it's hard to have a big enough move, right, to realize any gains when you hold a call and the implied vol is 125%. You need to have a really big move. And again, from a fundamental basis, maybe they can quadruple earnings or something and justify those implied vols. But it feels like a lot of those gains have been pulled forward already. And if that trade stalls a little bit, then you have to wonder, okay, do we rotate back to Mag 7s, which have not been breaking out, to your point about the Mag ETF before. So, there is a little bit of room for possibly rotation, but I just think that those names are the ones to watch there. Little tech issue there, Oliver?
Well, Brent, here's kind of what I'm thinking from the earnings standpoint is the momentum, to your point, very, very strong for LRCX, for SNDK, but also the price at which it costs to own premium here, I guess in either direction, right? It kind of makes it, I don't know, would I want to own the premium in the direction it's been going, or would I want to, if I've got the stock, I feel like that's a totally different thing, right? It seems like, maybe you can use some kind of a spread or something, but just buying stuff outright in one direction is pretty tricky.
I think in this case, what you have is a situation where single stock options are quite expensive, right? And so there are interesting trades you can set up with there. But on the risk side of the equation, you're saying, well, Brent, you're saying there's high risk, but the index vol is so cheap. I mean, the IV rank for spider options is an 8. Okay. So what that's telling us is that the implied vol there is as low as it's been. And so you can express both upside and downside. Yeah, you can express upside and downside in that space for quite cheap. So, that's quite reasonable.
The potential then to hedge the stocks with the index sounds pretty good. Is that fair to say, Brent? If I've got an SMH, if I've got tech, but the single stocks are too expensive into earnings, then maybe I hedge with an index put, right?
I think that's totally reasonable. Orvix call spreads are totally reasonable, and so you can keep that equity exposure on and add cheap and add that cheap hedges, right? And I think that's a nice thing about sitting here and saying, hey, things seem a little bit risky here, because that hedge is really quite cheap, and that's what I think is nice about it. On the same point, when you are considering the path forward here, and there's plenty of reasons to think that, okay, vol contracts if these macro points out of this the next 2 days are no big deal. I think we're getting a lot of back data as well from the government shutdown. So, there's a little bit more information on the macro side coming out these next 2 days. When you have the situation where the single stock implied vol is cheap, stock replacement is also, quite valid, when you have that very cheap equity implied vol, and you can express yourself both ways there. I think, that makes a lot of sense. But a lot of these trades just feel very, very crowded. I mean, the silver gold trade, that trade is just huge volume, massive implied vols, and it just feels very hard to squeeze anything out of the option space in single stocks, these commodity names, et cetera. So, it's very uncomfortable for me to sit here and wave the risk flag, when we're breaking out to all-time highs. But it's hard to kind of read that data any other way.
I mean, look, the way that we've read the data for the flows around gold and silver, it's, don't try and fight the current when it's so powerful in one direction. The fact that we were doing SLV, options volume close to spiders was pretty crazy. And if that's skewed generally to the upside, it's like, good luck trying to fight that, You can try and get technical, you can try and get smart and cute, but you might just get your face burned off. I think that's how a lot of people have trying to fade that move.
And that's true, and not just silver, but these other names that have been kind of the vector of attack, right? Like Sandus. You think that selling the call implied vol at 100 or 200% is a great trade, and unfortunately, that seems to, that can just rip your face off as well. So it makes shorting this stuff very tricky. You can put on some interesting trades like put flies or put spreads, which can be interesting, where if these names revert, the vol actually comes in, which I think is really interesting for LRCX and SanDisk into earnings, because usually earnings triggers a collapse in implied vol. So when you have extreme implied vol and you have earnings, you could have that stock down, vol down in a major way, which can set up some really great trades for those of you who are a little bit more active. But from the fundamental perspective too, you think about overwriting in some of these things that are a little more expensive. There's a whole bunch of great options trades that are available here, and I just come back to that other core point is like, look, when you have Spider IV rank at a 5 and the skew is exactly in the middle of where it is over the last year, that's just telling you that you can buy calls or buy puts and Spiders and express yourself on the cheap, which is ultimately I think a good place to be. And really what the goal here is you want to skate to where the puck is going, is kind of the famous hockey analogy.
Right, exactly.
And so, that is what's interesting about this. Everybody knows the bullish.
Your head against the wall.
Yeah, I mean, everybody knows the bullish analogy here, right? Like we buy semis, we buy chip stocks, like that's the leader here. The inflation is going to lead equities up over time and passive inflows and all the other stuff. And, you really can't fight that dynamic. Every dip in history in the S&P 500 has been bought, no doubt about that. And there's a lot of bumps along the way, and if you can navigate those bumps, that's where you outperform. And so I think that warrants some consideration in and amongst this environment.
Hey, I see a lot of GLD up there for the largest daily trades, man. A lot of GLD in there. I know John's got thoughts on that on deck too. Coinbase, though, I thought was interesting. Give me a quick thought on that just real fast, Brent, because that's kind of like creeping up there for big options flows. I don't know, maybe crypto will shrug off Master, which has been still very weak. I'm curious to see that one in there. Yeah, the
Bitcoin trade is really interesting because it really was starting to break out with gold and silver, and maybe you make some of the ties to, hey, there's the de-dollarization aspect, or it's the safety trade,
sure.
Where if the U.S. is going to come and steal your assets, you want to run into Bitcoin or gold and silver. Those are the edge, and that trade really unwound, right? And there was some news out about some quantum computing possibly breaking some of the Bitcoin ciphers or whatever it may be. And yep. Is that warranted, right? Is that real or is it not? But that seemed to kind of sync with some of the weakness there. So I don't know enough about that space to sort of flag that. But you start to wonder if that's the idiosyncratic risk there in that crypto space, where it was starting to catch that bid, right? And the volumes were starting to creep up. Remember, Oliver, we were seeing IBIT and in Ethereum, ETH show up on those top volume ladders, and now they've kind of disappeared, right? So you need something. I mean, it's there at the bottom at 412,000, but you need something to get the attention again. And to be honest with you, people want to go to where the action is, right? The prettiest girl at the ball right now is certainly silver and gold. And so, if you're in that space, you're going to go to silver and gold because that's where the trading action is versus IBIT, which, has kind of been left for dead at the moment. So, Coinbase is certainly an interesting trade with earnings kind of coming up. There's a little bit of action there, but I hesitate to say, that it could be any more than something of a flash in the pan around earnings, where the dynamic is just much more interesting in the metal space versus that Bitcoin place.
Yeah, that's true. Pretty clear downtrend still for coin. Maybe something turns around on earnings around the corner. Seems like the options flows are starting to get kind of interesting there, according to the SpotGamma data. Always good stuff, Brent. A pro working through an echo too. Nice job. Appreciate you, sir.
Thanks, Oliver. Take care, bro.
You got it, Brent Kochuba. SpotGamma, nice look at the options flows here and the overall market, which is pretty penned, pretty calm right now, but we still got a lot of action because we do have two big economic pieces of data that are coming out this week with inflation. And I got Mr. Jon Najarian on the line. I'm going to bring him in here for Market Rebellion as we think about the Fed and the message today from Mr. Jerome Powell, who's basically saying that he seems pretty comfortable for now. John, what's up, sir?
Hey, what's up, big dog? I just had to.
What's going on, Dr. J?
I'm over here in Austria, taking advantage of some great skiing conditions, and
love that.
Yeah, also doing some trading. So just
There
like
you go.
Brent said, and like you said, we've got the GLD just exploding
Right.
to the upside. Silver and spot silver just moving up like crazy. I mean, it's a fun time to be trading the metals, that's for sure.
They liking it over there? What's the message in Europe on the precious metals? They're on board? You know, is this now going global? Is this like the biggest trading meme of 2026?
Yeah, they think that that there must be gold mines in Greenland, and that's why Trump wants it so bad. But
I've heard
you and
the
I
rumors.
know, yeah. Well, you and I know it's the rare earths. It's the REEs. You know, everything from lithium and cobalt and manganese and so forth that are what the U.S. needs for the missiles as well as for EVs and things like that.
Yep.
So there's a lot of focus on MP, on USAR, of course. A lot of unusual activity in that one, man. And a lot of the folks over here think that it's got a lot more room to move.
Oklahoma-based USA Rare Earth, USAR, neodymium. Technically, I'm a materials scientist by trade, John. I don't even recognize half these materials. I got a degree in it. I got an Ivy League degree in materials. I don't even know what these are.
Yeah, it's one of those deals right now where you have a lot of people focused on things that we know we need, but there's again, when you've got a situation where you've got more demand than supply, you're going to see higher prices. We've seen it in silver, we've seen it in gold, we've seen it in lithium, LAC, Lithium America, and so forth. And I think right now the United States has investments already in LAC, MP, and Trilogy. And it's likely that this USAR is going to be the next one because this is something that in a global market, people are going to say, well, there's not enough of this stuff, Oliver. And whoever owns it is going to be able to basically dictate terms to the rest of the world.
TMQ, Trilogy metals, right?
Yep.
$7.
Trilogy.
Chart looking pretty interesting. They do kind of look like they're setting up for, I'm not going to say a silver type move because that's like, multiple standard deviations outside the norm. But when you see this kind of ascending triangle, if you will, it's actually generally a pattern that I find to be pretty compelling because it's got the combination of trend, where it's going up and to the right, but then it's also got a period of consolidation that kind of helps it gain some momentum before a big move. So, trending basically, since December, and now kind of chopping around the $7, where I guess you look forward to rip ideally.
Yeah. But when I look at all of the other, plays that there are out there right now, from, for instance, Seagate today, STX with that huge
Monster,
upside,
just extraordinary.
monster move. You're absolutely right. And then, when NVIDIA eventually, I don't know when this year, but when NVIDIA breaks out of this range, it's going to run. And China approving the H200 chips was big for Micron, MU. It was big for anybody in the space, Intel, basically anybody, Oliver, that was working in this space was going to benefit from a big surge like we saw. coming from the news out of China with Intel. I'm sorry, with NVIDIA. I'm sorry.
NVIDIA. Yeah, no, I'm with you. I've been watching that range in NVIDIA, and in fact, actually, if I update my chart here, kind of drag the box over because it has extended. It's basically been like 195 to the upside is when you start getting some resistance, but support at 180. We spent, less than a full trading session below there just 8 days ago, and it sprung right back. So when I look at that recent 6-day chart for NVIDIA, if I look at MAGs, which kind of puts them all together, right, in the MAG 7, boom, bounce right off support at 63 bucks for MAGs. And you know what I love, John, as a trader, is when you don't need to draw new lines, you've already got them ready,
Yeah.
When you've got something set up and then it adheres to that, it really suggests that, you're viewing the trade right. You're viewing the technical situation right. So the fact that NVIDIA firms up, MAGs are firming up, I mean, after going sideways for months, this is the preferred group to lead, in my opinion. This is the group you want to be in front.
No, I totally agree. I think TSM, sort of led things off in the recent past, but obviously you look at Intel, since we bought in at 20 bucks a share, we collectively, the American people, bought in through Trump's $9 billion investment. That stock's been almost straight up, except for those 2 days when we had that correction, Oliver.
Yeah.
That's been almost straight up. That's a data center play. We've had VST that's had, from the data center side, a lot of love lately. And I think we're going to see a lot more from exactly the sort of companies in the tech side that ultimately feed into the defense side, because those same chips are in virtually every defense company, whether it's, Boeing or Lockheed or Northrop Grumman or General Dynamics. You're going to see all of those catch the love. And then the smaller ones are CAT, RCAT, AVAV, Iron. I always have a trouble pronouncing that one.
Aerovironment.
Environment. Yeah, that's right. I think all of those take advantage of what they can do with the chips. And that is why we are such, raging bulls about the chips.
Yeah, no, I'm into it. It's the clearest trending group, and it's just a very simple core trade. Oh, you like to, this is the way my conversation goes with a lot of people, John. They say, hey, what should I invest in? I go, oh, so you like stocks? They go, yeah. I go, what do you like about stocks? Oh, I like that stocks will make money. They want them to be profitable. I want them to be disruptive. Okay, that's tech. What is that? It's semis. Like, that's okay, but I also want something that's value too. Well, a lot of these, when you normalize them by their growth, they look like value. So it's just, don't fix it if it ain't broke. And if you want, to get specific, like you're saying, going into specific names, fine. You'll get some more bang for your buck there. That kind of depends on your risk tolerance, right? To each their own. But either way, most of the bullish trades right now funnel up into semis in my mind.
Yep. And that's why, TSM or Lam Research or ASML or Global Foundries. That's why these stocks are kind of like, I'm not so much saying secondary, but they're definitely plays where people should keep them on their watch lists.
Yeah, no, I'm into it 100%. The chart is very clear. I like the specifics too around the earnings. Well, I got you though, John. Speaking of risk tolerance, let's go through the Kalshi bets. Let's do a little gambling here, but let's talk some economics today. Your brother and I talked some of the sports and some of the more political-oriented stuff yesterday, but with Fed session today, I pulled up what Kalshi's got for a few of the economic figures. Number of rate cuts in 2020, for example. Look, it's not going to be Powell. Market's saying 2 cuts. So what do you think? 23%. Market's basically saying same percent chance of 2 cuts versus 3 cuts. and 4 is only slightly behind. 4 is at 16%, whereas 2 and 3 are both at like 22, 23, which I think is kind of interesting. It basically leaves the whole door open.
Yeah. Well, when I looked at the CME tool, I was looking at it thinking, well, we're likely to see some cuts, but not until June, not until Powell's out, because he's done a masterful job telling people that he's data driven, but he is not data driven. If he is, he would have made more cuts in 25. So
you wanted
in
him
my
to cut
opinion,
more. Yeah.
Yeah. Not only did I want him to, I wanted him to be true to what he said, because he said he was data driven. I don't think he is. So that's okay. I think we'll get 2 cuts. Do I think 3? Not so much. But I think we'll get 2 unless things get kind of hairy, about a second shutdown and so forth. I mean, we're coming up on a partial shutdown of the government. I hope it doesn't last as long as the record breaker that we just saw.
Right. Yeah.
On the other hand, again, we're right back here. We traded 7,000 today, early in the morning for the S&P. So does that scare me that we already had a shutdown this year and we're at all-time highs? Not a bit.
Right.
Not.
Usually a buy the dip opportunity. Anything, any political DC fear. When it comes to the impact of cuts, I will say, John, what about if this dollar keeps getting obliterated? Will you then say, look, maybe they need to chill, maybe they need to kind of, not stoke the flames? Because, look, I've been generally bullish, hopeful in the dollar throughout all of it, which has generally been the right view. The dollar's at least been range bound after touching some highs. But, man, the last 3 days looks rough to me, John. That looks like it might be a message saying, careful about toying with inflation again.
Well, and tariffs. It's about both. But if I asked you, Oliver, what would you rather have? Would you rather have American goods? I mean, this plays right into Trump's America First, because the more the dollar goes down, the more our goods are attractive to overseas buyers. And the less attractive overseas goods are to our buyers.
Sure.
Obviously. So do I think this is the overall 4D chess plan? Yes, I do. And I think I wouldn't be surprised to see much lower numbers for the dollar versus euro, dollar versus yen, across the board.
I'm on the side where our biggest exports are tech, baby. Export. Dollar, I don't think is going to have a big of impact on that. Goods, I know some places they want to, we want to sell goods. Some industries we want to keep alive. I get it. I respect that. We don't want to just completely fall behind. But also, I'm fine with the strong dollar, so I can just buy, John. Have the rest of the world make the stuff for me. So I can kind of cut it both ways. But I hear you there that there's other factors that might be tangential to kind of the cuts and the Fed side of it. GDP growth. Here's one for Kalshi, John, real fast. Is the odds of this going up and up and just keep increasing. The fact that we could get GDP above 4%, is it 70%? 4.5%? Is it 37? I mean, up and to the right for months. I feel like that's a really good message about the economy.
Yeah. Well, 5.4 was the preliminary number for the fourth quarter. Will we hold on to that? I hope so. And Elon Musk and David Sachs have been saying we're going to see 6 and 7. Now, for a real economy, I'm like, that's amazing. That would be amazing. So people will definitely respond to that, I think, Oliver.
Yeah, I'm on board with that. I mean, I would love to see that. Bring it on. Give me that 7% GDP. Let's go. I would be very surprised if the dollar stays subdued where it is for that long. But hey, anytime you see the expectations, whether it's Atlanta Fed, if it's Kalshi, if it's whatever, up and to the right for expectations of GDP is pretty darn good. So we'll take that one. I think the same kind of goes with our conversation about any risks, though, John, is if the Fed does like some big juicy cut while we're cranking 6%, we could be boy, that could be running this economy hot. By the way, last point is 23% chance. Kalshi says that there'll be a Fed cut greater than 25 bips this year. John, what say you?
Well, that would imply that we have a situation, Oliver. And by situation, I mean we'd have something that would scare the Fed governors into making a 50 basis point cut. I'm assuming 50, not 75. So I'd say the odds of that are probably 10%. Kalshi, like you say, says 23% chance. I think they're giving it a little too much credit that we could see something that big.
Yeah, that's I hope not, right? I hope that one probably doesn't come to fruition. Because to your point, that's probably out of a situation, that we'd rather not be in. Great stuff. Love the bets. John, thanks for Skyping us Zooming us rather, from the Alps.
There you go. Thank you, Oliver. Great
Don't
to
get
be
too
with
burned
you,
that
sir.
European sun, man. Be careful.
All right, I'll be careful.
And as Pete put it, don't be cutting in front of the line, Make sure.
Yeah, I don't.
That's the snowboarder problem.
That's right. They do love watching the gamble over here, and you wouldn't believe how many people over here watch your shows, Oliver. I'm flattered to be on it. Thank you.
Beautiful. I love it. Need some of that Euro love. Jon Najarian, thanks, man. Appreciate you coming to us from Market Rebellion. Of course, we got more ahead. Hans Albrecht joins us for some extended thoughts on the tech trade and more. Joining us from Gamma Option Solutions next after a 2-minute break. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. All right, don't look now, but silver looks like it's about to do that thing again, just ramping right back up. Incredible. Stocks holding on. Good day for tech, good day for the NASDAQ, but boy, the gold and the silver story just, it seems like it's got infinite legs. Hans Albrecht joins us, CEO of Ghana Options Solutions. Hans, good to see you again. As I'm talking, literally silver's pushing through 117 bucks on the future. I'm gonna pull up the chart. It's just bananas, man. Won't stop.
Well, this is it, Oliver. And so I think what folks have to kind of get through their minds is that a lot of this isn't, I mean, I've heard people talk about it as a mania, and it certainly seems like it when something doubles in short order, platinum, silver, things like that. But there's something very, very important going on out there, and that's this sort of rebuilding, reindustrialization of the world, and especially this sort of, if you look at compute needs, especially if you look at Claude code and these things that are sort of getting very viral, compute needs are going to just go parabolic, absolutely parabolic. And so, you know, there's a very structural reason for some of the moves that we're seeing out there. And I think that's why they're well bid every time things sell off. You think about it, silver is a very small part of a number of devices. So if silver's 50 bucks or 300 bucks an ounce, that really doesn't make a difference. If you absolutely have to have these components, whether it's silver or rare earth of some kind, to build things, this is where we're at, right? This is where, you know, economies, big tech revolutions run into bottlenecks, and this is a great example of that.
Yeah, it seems like bottleneck about to break again. Obviously, the contracts on SLV have been bananas. Obviously, it's getting more expensive, you know, to trade that. But at the same time, you know, the direction has been so clear. But how tricky does it make it, Hans? I mean, to try and use options when they're getting this volatile? Do you have to have a premium offset by selling some, in regardless of what direction you're going, or how do you think you play it right now? And whether it's SLV, you know, I mean, I just pulled up the option chain for SLV. It's just totally pumped up across the board. IV's above 100, 102 all the way out, at least 102 out to March. It was just, you know.
Well, and that's the thing. It's well warranted, and something that you'll notice over time is that, you know, typically people think of option pricing. You think of the VIX, the market rallies, and the VIX comes down because there's less fear. There's a compression of worry, and we're in a sort of normalized market, what we would consider normal. But what happens with parabolas, right? We've seen this quite a bit actually over the last year, when stocks or commodities or whatever go into sort of parabolic mode. Now, precious metals sometimes have that upside call skew that is generous, so it already has that head start. But we see this in stocks all the time, where the things going up and vol markets are pricing the unknown, because you look at a chart like that and you go, well, I don't know which is going to go. Is it going to go to 150? Is it going to go to 200? Vol markets have to price that in. And so what happens is eventually you're going to get a little bit of a pullback. That's when vol is going to compress, because that's when it says, oh, okay, we've seen a top, we found a seller, and now we're going to take some of the fear value out of those options. So right now, it's very difficult to get in the way of a parabola, and the vol is really telling you that. The only way that I can see doing something like this is in a very defined risk kind of way. You play maybe like a downside broken wing butterfly, very defined, and it's also something that's going to benefit from a compression. You get that Vega effect. If we pull back, you maybe get a little bit of compression as well as that directional delta. So something like that is a little bit more safe in my mind.
Okay, I like that. Makes sense, especially because you got multiple legs to this trade, which is the direction for price is one thing that you don't necessarily have to have a view on it, but to ignore the direction thus far would be kind of a very risky, you know, bet. But then also just the volatility that's been pumped up. So, you know, what's the scenario in which that volatility subsides? I think that is probably, to your point, kind of the core bet that you want to make, is the scenario in which that volatility might subside, which is a little bit more predictable, you know.
Exactly. And as an example, if you look back to the fall, we had very calm option markets last summer. Then the markets really ran up and everybody was sort of calling for a top, but we kept going and going. And eventually what happened? Vol started to push up, especially the upside call skew. So markets started to say, oh my goodness, this could go bananas to the upside. And so options eventually price that in. So that it's always good. I love to watch call and put skew to see what the markets are sort of feeling, because that's fear, right? If upside call skew is going bananas, market makers are not saying, hey, I'd love to sell a whole bunch of this stuff. They're backing off. Once you see it start to come in, that's a bit more normalized. So those are very, very important tea leaves for option traders to pay attention to.
Yeah, like that. When we're in this realm, I feel like it behooves us to go over to tech for a moment. We talked a little bit of some of the earnings moves. Seagate today, just explosive and eye-popping after earnings. But we've got some big ones. We got Apple right around the corner tomorrow after the bell. I know you've been watching Meta, so that's on deck for today. So what do you think here, Hans? Because the MAGS group looks like it's trying to come back to life a little bit.
It is, and this is interesting timing for us to talk about this, Oliver, because a couple of weeks ago, 2-3 weeks ago, we talked about it, and you said, "Are you buying MAG?" And I said, "No. I'm a little negative on MAG." So I'm going to rotate into some of the other things. We went into the broadening trade, which is still has some legs to it, but it's taken a little pause here as people return to tech in a way. But in the last week and a half or so, I've decided that it's time to shift back into those. So I've been buying some Microsoft, some Amazon, certainly some Google. And what is the reason for that? I know you want to ask me that. Why the flip, Hans? Well, it's because as we're seeing what's happening out there with software as a service, we're seeing the software sector get smoked. If you look at IGV, I think it's probably still a short. And what we are now facing in a world of infinite compute, which is basically what's happening because of Claude Code and this ability for agentic AI to make a real difference. What we are seeing is that there's a lot of disruption. People are starting to worry what sectors are going to make it, what sectors are not going to make it. Well, I'll tell you one thing I do know is I don't know who's going to really make it or not make it, but I do know. Think of it this way: it's like a highway. Who builds the highways, the cloud highways, all that stuff? It's Amazon, it's AWS, it's Azure, it's Google. They own the highway. All the little businesses alongside the highway.
Right.
They may succeed.
That's
they
a
may
better
go out of
bet
business.
than trying to make the bet on who's going to make the best new car for that highway, because some of these big software giants, they used to kind of own their own lanes, but smaller, more nimble AI trades can slide right in there and take that lane.
You got it, Oliver, and that's what I like. I like the idea of the toll booths, right? So in an uncertain world, I think this group has a couple of things going for it. Now, I know we have earnings coming up, but I don't think they're going to matter so much, because think of a couple of very important things. When there's uncertainty, people kind of go, uh-oh, I either want to broaden out and take advantage of the things that we were talking about in your last show, which is, hey, I don't want to worry about which chip maker is going to make it. I'm going to look at the part of the economy that's now going to use AI. It's going to benefit from the uses of AI. But if I'm going to stay in tech, balance sheet, fantastic balance sheet heroes, incredible revenues, although they're probably not as good as they were a year ago, but incredible revenues. They're spending a lot of money. The CapEx is cutting into cash flow, but these are dependable businesses. They're utilities, but that also have growth, and they are the toll booths of our new world. So I think that makes them very interesting. And as I said, we are about to see compute go parabolic, and that's playing into power markets. It's playing into silver, copper, etc.
Yeah, I like the toll boost because I've described some of these. I talked about it similarly with Netflix a while back as kind of being the new entertainment utility, where you have this just reliable income that's kind of like a utility-based thing. But to some extent, these companies are the same as well in that regard, and that they are creating this avenue of recurring, reliable usage, charging fees, allowing for creators to create, allowing for entrepreneurs to innovate. And so having that kind of baseline narrative is strong, and I'm with you. But I also, Hans, I could forget everything we just said and just look at the charts, and they all hit right on support. Lines that have been key for a while, whether it's Meta bouncing off 600 even, if it's Nvidia, which bounced right off 180 after at the end of last year finding support at 170. They just, and then MAGS too, the ETF, they all look like they hit right on key support.
I was going to say that because you mentioned with John earlier, you said, isn't it amazing how these trend lines hold for a long time? And I was going to mention that very name, MAGS, perfect, absolute perfect touch. Look at XLK, which is telling you all you need to know. Money is definitely shifting in there. I'm not saying that the broadening trade is over, but in my sort of roaring 20 scenario, I think a lot of things can do well. Right now, there's a recognition that that this sort of agentic move, I think that's going to be maybe the biggest theme this year, is really going to push people into using those highways. There are going to be a lot of people driving on those highways. And whether we make 20 million new apps and 99.9% of them fail or lose money, that doesn't matter to the toll booths because they get paid anyway.
Yep. The other thing too is that charts, the bears, bears can't refuse a good double top, and they always seem to lose. The double top pattern is like the hardest. Now, there were a few big ones in history. There's a pretty clear double top. I think it was .com, if I'm not mistaken. But usually these things are suckers for people trying to fade, say, oh, we're going to get rejected, because the Nasdaq's right at where we were in October. But more often, what this is just a sign that we're going higher. You get back towards the old highs. The S&P has already gotten through the highs. The SMH has already gotten through the highs. I just don't see a lot of scenarios in which NASDAQ goes right back to the old highs and then suddenly just fails. So if you get a Meta through 680, that could be all it takes. If you get, an Apple just to even turn around, maybe get above 260, something like that. There's a lot of ways I could see the NASDAQ breaking out. But to your point, Hans, does it preclude the small caps? Does it preclude the other stuff from hanging in there? I don't think so.
I don't think so. I think that, and I was going to say that you got to me first, but I could say this isn't going to be like 2 years ago where it really is a story of a handful of stocks. This is going to be the broadening. This is happening, and I think it's actually fascinating. If you look at some of the stuff that people don't even think about, you look at some of the builders, the Quantas who fix power lines, the BWXTs that are going to be involved in building nuclear reactors. GEV had great results today from GE Vernova. You've got power, you've got infrastructure there. You have a whole group of things that are breaking out as they look towards the next 3, 4, 5 years of durable growth, right? We're not rebuilding the world and retiling the world for 5 months. We're doing it for the next 5 or 10 years. So there's some great stuff out there. And while the US market as a whole is not that cheap anymore, there are pockets where there is still value in areas that have been underappreciated for a long time. So there's tons to look at.
GV, a pretty good looking chart again after having this incredible move the last couple of years. That's another one where you've got a chart that's coming right back up on recent highs for GV, $730. It's at 715, 720 and change. What else we were talking about earlier is the silver chart, which is going right back up to the recent highs. There's just a bunch of these things that have been good momentum trades that look like they're gearing up for another round, whether it's equities on earnings, if it's commodities. I just would want to be very careful trying to short risk assets in general right now, Hans. That's kind of my main conclusion, I think.
100%. This is a bear trap scenario. If there are any bears left, I think it's a very dangerous environment. Now, I always in the back of my mind, if we do have 30 seconds, I'd say, some things were in a sense that, a lot of disruption eventually can sort of feed into the market. So you see what's happening, entire sectors getting sort of sideswiped by AI. At some point, it starts to worry people. And one thing that I've been thinking about lately is the security risk. So when you think about everybody, I don't know if you've read a lot about this sort of Claude Code, co-work and all these things. Basically, people are installing this stuff on their computers. They're saying, go at it. Here you go. Here's all my personal information. Here's all my stuff. At some point, that is going to be a risky thing to do, and everybody's excited about it.
It's a little bit daunting, just to like turn it over to the AI. Log in. Yeah. You've got everything. You got my email. You got my contacts. You got my notes from my private conversations. I better darn have some good security.
Yeah, and also think about people come home, right? You come home, you're working on stuff. Maybe you work at the government. You come home, you're working on things. Suddenly, the people at work don't understand. You've now installed this thing on your Mac Mini, and now it's watching everything, and it has control of your emails. You're slinging APIs around like they're candy. This is a very big risk, and I wonder at some point if even the government's going to come out and say, "Listen, we have a big problem here." And so I think you want to start thinking of some of the big stocks like Microsoft have, I mean, they have security within their ecosystem. So it's not like it's not there, but I think the security area looks interesting. The only problem is it's software. So are the Palo Altos, are they going to figure this out? But I think this is the beginning of, you may have heard it here first or maybe not, but I think in a few months we're going to be talking about this, how there is some very, very big risk in handing things over. And what I've heard lately is that some people are saying, well, tokens are too expensive with Claude, so I'm going to go use this Chinese LLM, this Chinese. So now the Chinese LLM has a view of all your files and maybe sensitive information. Yeah. So we are opening a can of worms like the size of Argentina. It's unbelievable.
So that's an interesting point, because then basically if you kind of round out the whole tech trade, then to kind of wrap it together, is the SMH is the core. It's the semiconductors have been leading, trending. The mags look like they've got potential to extend this recent bounce. Software as a whole is weak, but within that software category, there's probably going to be a need for some of the top-ranking security plays. That's kind of your whole sphere, the contour of the tech trade.
I like that. And think of the toll booths, right? There's sort of think of, I can't live without. Put that in front of any stock you're considering buying. If you're looking at stocks and investing right now and not having AI as part of your thought process, you're not doing it correctly. And so you really want to think of, when the software sector melted down, well, that's what happens, right? In a mania on the way up, they buy everything. Then they figure out who's good or not. And a big sell-off, they sell off everybody. They take no prisoners. Now you're seeing some areas of software, maybe the data stocks, maybe Datadog. I think they're going to put up Datadog, Snowflake. I think we're going to see some good numbers from some areas. I think Adobe, I've got a short on it. I'm still negative on that one. Maybe CRM figures it out, but I'm also reading about people, creating CRM in about 3 minutes with Claude Code.
Totally.
So really,
Adobe and CRM, I think, are in tricky spots. Autodesk to some extent as well. Adobe in particular, just the graphic stuff gets done so much faster, and they've got their own built in, but I've used it significantly, and a lot of times it's a lot easier to go directly to the AI competitors than to try and tweak already within the system. I think Salesforce, to your point as well, I mean, the chart you got to look for something more on the chart before you, at this point, if you start believing in CRM, you're kind of just hoping for a gamble, I think, because the chart's miserable.
I think you're right. You want that confirmation, because some charts are telling you when there's an issue, and they can get it wrong. Look, maybe Adobe's going to double because they figure this all out. But I think what the market is saying right now is we don't know. We don't know. We know how things are looking now. Good cash flow, good multiple, but we don't really know how things are going to look 3 or 4 years from now. And that's really where we are. We're in this binary environment in some areas of the economy where we don't really know what's going to happen. And as we know, markets don't like uncertainty, so they are very much they're going to push into the big winners and they're going to overdo it there, and they're going to push out of the ones that have uncertainty surrounding them, and they're going to overdo it there probably. So Here we are.
Nice, good analysis, great stuff. Good tech deep dive there into each facet of the group. Hans Albrecht, nice work, CEO.
Thanks,
Gamma
Alder.
Option Solutions. Yes, sir. Thank you. Nice there from Hans, as well as Jon and Brent Kochuba. My closing thought as we go into the bell here for 2 minutes, real fast, as we go into economic data, as Hans left off there. That is kind of the end of the week. The risk radar, red on bonds, red on the dollar, green for gold. And by the way, the silver move just up 10% today. As we were talking there, it's just unstoppable. Here's one last look at the chart. 116.53 for the future right now. 117.7 was the intraday high from Monday. But look at the way we're moving here. These are types of charts that generally don't disappoint if you're looking for more extended upside. Here's the reason for why. It's basically an ascending triangle. You got support going from bottom left to upper right, which you love to see. A period of consolidation to rest and reboot. Impressive stuff from silver once again. Gold here, 54.11, just straight up vertical at this point. But how can you take a green light off something that's been so reliable? Look at the RSI for gold, absolutely cooking in that bottom panel. Relative strength right now at 89. But here's the thing. Look at gold from back in September. You had RSI continuing to make higher highs, so don't run from it just because it's hot. However, I think that we should probably be expecting more candles like we got the last few days with silver, where there's some consolidation alongside the chop. For tomorrow, the key figures from the economy are going to be generally, I think, the factory orders is your biggest piece, but productivity and costs and jobless claims, of course, are important as well. Here's the catch with that, is that I think we've got inflation on the number one ranking list still, which is going to be on Friday. So bonds looking for more weakness, not getting back down through 4.2% anytime soon right now. That's why it's red on the risk radar. But we did find a little support bounced off, so I think that fits pretty well. Thank you for joining Chicago Future of Finance. That's it. We heard the bell, 3 p.m. in Chicago. Have a great night.